In today's episode, we're talking about scalping. We'll break down what it is, why some traders love it, and what kind of person it suits best. We'll also compare it to other styles like day trading and swing trading, and go over the pros and the cons. If you find this helpful, go ahead and hit the like button, subscribe to the channel, and tap the notification bell so you never miss a video. Let's get started. Scalping is a fast-paced trading style where you try to make lots of small profits by entering and exiting trades quickly, usually within minutes, sometimes even seconds. The idea is to take advantage of tiny price changes, often just a few cents or pips, and do that over and over again throughout the trading day. So, why would someone want to be a scalper? Well, for starters, scalping avoids overnight risk. That's the chance that news or unexpected world events affect your trade while you're asleep. With scalping, you're in and out quickly, so you're not holding anything when the market's closed. Scalping also gives you more opportunities. Since you're trading many times a day, you don't have to wait hours for one perfect setup. This strategy works best in markets that have high liquidity. In simple terms, markets where there are lots of buyers and sellers. The more liquid a market is, the easier it is to get in and out. For a retail trader with a small account, it can be very difficult to make meaningful profits. You'll need to use leverage, which we'll talk about in later episodes. Many retail scalpers rely heavily on technical analysis, looking at support and resistance, indicators and price action patterns to predict short-term price moves. They're focused on what's happening in the current moment. Retail traders rarely scalp news unless they've paid for a news feed, as the move will likely be over before they enter. For the retail trader, scalping news can be very expensive if you don't know what you're doing. Popular markets for scalping include major forex pairs like euro-dollar, large cap stocks like Apple or Tesla, futures like S&P 500 E-minis, and cryptocurrencies. Is scalping popular? Yes. It's one of the most widely used intraday trading techniques among both retail and institutional traders. However, it does require discipline, laser-sharp focus, and the ability to make decisions under pressure. Unless your account is very large or you have high leverage, gains are typically small, so you will need to make multiple trades per day. As each trade incurs fees such as spreads or commissions, the high frequency can mean costs add up quickly. Don't let this put you off. There are lots of scalpers who make a very comfortable living. Books like Market Wizards are full of stories about enormous profits made by professional traders scalping. Most scalpers work with very short time frames. We're talking about 1 and 5 minute charts. These time frames are typically very volatile and more difficult to predict than the hourly or daily chart. Trades might last 30 seconds to 5 minutes, and rarely longer than 15. Scalping isn't about big moves. It's about stacking small wins over time. Because of the pace, scalping usually requires advanced tools, such as a solid internet connection, a fast trading platform, and often access to things like level 2 data. That's extra detail on market orders to give you the edge. So, can anyone become a scalper? Yes, but there are a few things to be aware of, especially if you're in the United States. In the States, there's the Pattern Day Trader Rule, or PDT for short. It says that if you make more than 3-day trades in a rolling 5-day period using a margin account, you must maintain a minimum balance of $25,000. That can be a major hurdle for newer traders. In the UK, the rules are more flexible for retail traders, especially with CFD contract for difference providers. But scalping may be restricted by some brokers. Always read the broker's terms and conditions. So, let's compare scalping to some of the other trading styles out there. Scalping is the shortest term method. You're in and out within minutes, sometimes even seconds, making many trades each day. You need to recognize the opportunity and perform the data analysis quickly. That makes scalping an intermediate to advanced skill. Scalping is for traders who enjoy intensity and immediate feedback. As the gains are small, this requires the most time in front of the screen. Day trading is still fast-paced, but trades usually last from a few minutes to several hours within the day. Typically, people take 1 to 5 trades per day. As the pace is slower than scalping, it is more beginner-friendly, often using higher timeframe charts which are less volatile. Then there's swing trading, where positions are held for multiple days or even a few weeks. This allows lots of time for analysis and is the easiest way to trade around a full-time job. You only need to check the charts once or twice per day. And finally, you have position trading. That's more long-term, holding for months or even years. This is for people who like a slower, big-picture approach, investing their money. Each approach suits different personalities. If scalping isn't for you, that's totally okay. Alright, let's do a quick recap of what we've learned. Scalping is a fast, technical trading style built on making lots of quick small trades. It appeals to traders who like short-term action and instant feedback. While it offers benefits like avoiding overnight risk and creating lots of trading opportunities, it also comes with challenges: high stress, high volume, and sometimes strict broker rules. It's not for everyone, and that's okay. There are other strategies that might suit your style better. What matters is finding the one that fits you. If you enjoyed this video, please give it a thumbs up and subscribe. Also, take a look at our next video, where we'll explore day trading in depth. Thanks for watching, and I'll see you in the next one.